I would like to talk about the difference between the Islamic economic system and the conventional economic system. These two systems are widely used around the world, and although both aim to develop the economy and improve people's life, they operate based on very different principles. First, the Islamic economic system is guided by Shariah or Islamic law. This means every economic activity must follow Islamic values that emphasize justice, honesty, and social responsibility. In Islam, the purpose of economic activities is not only to gain profit, but also to ensure fairness, moral behavior, and the well-being of society. Biggest differences is the prohibition of riba or interest. In Islam, interest is considered unfair because it allows profit to be made without effort and can burden those who borrow money. Instead of charging interest, Islamic finance uses concepts like mudarabah and musyarakah, where the bank and the customer shares profit and also share risk. This makes business more ethical and fair for both parties. Islamic economy also allows investment only in halal and ethical industries. This means activities such as gambling, alcohol, and anything harmful to society are not allowed. On top of that, Islam encourages wealth distribution through zakat, sadaqah, and waqf to help the poor and reduce inequality. The goal is not only financial success but also social justice and stability. On the other hand, the conventional economic system is based on secular principles. It is not guided by religious law. The main focus is profit maximization and market efficiency. In conventional finance, interest is allowed and commonly used in loans and investments. Banks earn profit through interest and even if the borrower suffers losses. Conventional economy also allows investments in any legal business, even if it harm society, as long as it brings profit. Wealth distribution depends mostly on market forces and charity involuntarily rather than compulsory like zakat in Islam. Conclusion: while the conventional economic system prioritizes profit and market freedoms, the Islamic economic system aims to balance profit with ethics, social justice, and fairness. Islamic economists encourage financial growth, but always in a way that protects society and prevents exploitation. Explain the difference between Islamic loans and conventional loans. Two financial systems that may look similar on the surface but operate with very different values and methods. Let us begin with the Islamic loan system. In Islam, every financial transaction must follow Shariah principles, which emphasize fairness, honesty, and social responsibility. One of the most important rules is that riba or interest is completely prohibited. Islam teach that money should not generate profit simply by being lent to someone. This is because interest can lead to exploitation, especially when the borrowers face difficulties. Instead of interest, Islamic finance uses profit sharing and risk sharing concepts. For example, in Modarabah, the bank provides capital with the customer manages the business and both share the profit according to an agreed percentage. In Musyarakah, both parties invest together and share profit and also risk fairly. Another common method is Murabaha, where the bank buys an asset and sells it to the customer at no profit margin, and Ijarah, which works like leasing, where the bank earns income through asset rental, not interest. This ensures that money is connected to real economy activities and support productive business, not debt burden. Now, let us look at the conventional loan system. In this system, loans are based on interest or riba, which is the price paid for borrowing money. Banks lend money and expect repayment with interest, regardless of whether the borrower succeeds or fails in their business. The bank's profit is fixed and guaranteed, while the borrower carries most of the risk. This structure can sometimes lead to debt traps, especially for individuals or businesses facing financial challenges. Conventional loans focus on profit maximization, and they do not require transaction to be tied to real assets. As long as the borrower pays interest, the bank makes profit. This system is widely used around the world and is driven mainly by market forces and financial efficiency. In summary, the main difference between Islamic and conventional loans lies in their purpose and principles. Islamic loans aim to promote fairness, prevent exploitation, and encourage real economic growth by sharing risks and rewards. Meanwhile, conventional loans prioritize profit through interest, even if it means placing more burden on the borrower. Islamic finance seeks a balance between financial success and ethical responsibility, while conventional finance focus mainly on financial return. With that, we can say that Islamic loans are not just financial tools, they are part of a moral and socially responsible system designed to benefit both individuals and society as well as whole.